Welcome to Manifested Publishers. My name is Mr. Mariga and I will teach you advanced management accounting. Specifically, I want us today or in this particular time to talk about one of the applications of marginal costing on non-routine decisions known as drop or discontinue decisions. Drop or discontinue decisions. Now, sometimes the management of an organization may be faced with the decision whether to continue producing a product that is generating losses or that has low profit margins compared to its other products, or whether to continue producing that product that is loss making or has low profit margins. The management of an organization should decide whether to continue or discontinue production of that loss making product by considering the profits before discontinuing its production and sale and the profits after discontinuing its production and sales. Okay, so we will simply here then, or we simply compare the profits. We compare the profits or contribution before discontinuing a loss making product production and sale of a loss making product and B after you discontinuing production and sale of that loss making product. Of loss making product. Then your decision here will be based on the highest profit. It will be based on the highest profit. The decision that corresponds to the highest profit is the one that the management will decide or will implement. We can do a question, we can tackle a question, and the question I want us to tackle today is December. Sorry. Question 1C. Which is TL Limited. TL Limited. December 2023. Question 1C. And the question states, TL Limited sells 3 types of mosquito nets branded Zero Fly, Y Fly and No Fly. Product Y Fly is currently generating profits below a target net profit of 750,000. The following table shows the selected data for the 3 products for the previous year ended 30th June 2023. You have the product, the selling price per unit of Zero Fly is 80, for Y Fly is 20, for No Fly is 30. Contribution margin ratio is 20%, Y Fly is 10%, No Fly is 60%. Sales demand in units is 50,000, Y Fly is 150,000, No Fly is 60,000, so that the net profit for the entire organization is 490,000. Additional information number 1. The above data is expected to remain unchanged if Servo Limited continues producing all the 3 products. The sales manager believes that profits can be increased by dropping Y fly due to its low contribution margin ratio and concentrate on the sales of zero fly and no fly. The entire workforce used to produce Y fly will be utilized in the production of no fly. The labor mobility is such that 3 units of Y fly equal 1 unit of no fly. To increase demand for no fly, a 10% price reduction will be allowed next year after dropping Y fly. Unit fixed cost is 6.5. TL, prepare statements on marginal costing basis. Prepare a comparative statement of profit or loss before and after dropping Y fly. Advise the management of TL on whether to continue or to drop Y fly. Alright, so we've said why the management is considering whether to produce a product or to stop its production. You will compare your profit or contribution before and after. So let's start with the first option. Option 1. The profits, or would say continue producing product Y fly along with who or together with no fly and who? The third product that was being produced was zero fly. So continue producing the 3 products. So this will be your profits. Your profits after producing the 3 products, the profits after producing the 3 products is how much? 490,000 shillings. Is 490,000 shillings. Let's go to the second option. Option 2. Produce products no fly zero fly but discontinue. Product 2. You want to discontinue which product? Y fly. You want to discontinue product Y fly. Okay. All right. Now, our contribution margin sales ratio, which we denote as CMSR, is 1 minus V over P. Okay. So the contribution margin of which product is given by P times Q, then you multiply by the units sold. You multiply by the units what? Sold. This is P minus V. Zero fly, your contribution margin sales ratio is currently how much? 0.2. 0.2. But you know, when you add your variable contribution sales ratio, it should give you 1. Your total should give you 1. Therefore, your variable contribution sales ratio will be 0.8 of your selling price. And your selling price is how much? 80. So that your variable cost is what? 64. Y fly, your contribution margin sales ratio is how much? is 20%, is 10%, is 10%. But you know, therefore, you can even say your contribution margin will be 10% of your selling price, and your selling price is 20. So this is 2. Therefore, your variable cost, this is your variable cost V. Your variable cost V will be 20 minus 2. That will give you who? 18. That will give you 18. And this working is very similar. Get your contribution margin by taking your contribution margin sales ratio of 0.2 by who? 80. That is 16. So that your variable cost will be your selling price of 80 minus 16, which is giving you what? 64. So those two answers should give you the same answer. Okay. Let's go to zero fly. Zero fly. Again, your contribution margin sales ratio is how much? Is 60%. But your contribution, we know, you can simply take your contribution margin sales ratio, you multiply by a selling price of who? 30, which is 18. Therefore, your variable cost will be 30 minus 18 is who? 12. 30 minus 18 is what? 12. Or that is also or. Now that we have our variable what? Cost for each product. We have our variable cost for each product. We want to identify what? Our profits before dropping. Which product? Product Y fly. So your contribution, you know, is P minus V times who? Times Q units, which is the same as saying it is your contribution margin. You multiply by your who? Your units of each. So let's start with the remaining product, and one of the remaining product is which product? Zero fly. Zero fly had a contribution margin of what? 16. 16. You multiply by the units. And the units of zero fly were how many? We continued selling what? 50,000 what? Units. 50,000 units. The other product that we want to sell is a product known as what? No fly. No fly. And no fly, this should have been no fly, not zero fly, no fly. Your contribution is how much? 12. 12. But you have increased your production. And how do we know we have increased our production? Note number what? 2. The sales manager believes that profits can be increased by dropping Y fly due to its low contribution ratio and concentrate on the sales of zero fly and no fly. The entire workforce used to produce Y fly will be used in production of no fly. The labor mobility is that 3 units of Y fly will be equal 1 unit of no fly. To increase demand for no fly, a 10% price reduction will be allowed next year after dropping what? Y fly. So let's change this. So we come here and determine our incremental units. The incremental units of who? Of who? No fly. Why? Because they're saying when you discontinue product who? Y fly, the extra units of Y fly or the spare capacity of Y fly will be used to produce who? No fly. Note number 3. The entire workforce used to produce Y fly will be used in the production of no fly. And here will be used in the production of no fly. Such the labor mobility is such that 3 units of Y fly will equal 1 unit of who? No fly. So 3 units of who? Y fly will be equal to what? 1 unit of who? No fly. There. But remember, how many units were being produced of Y fly? 150,000 units of who? Y fly. So how many units can we produce of no fly? So the units of no fly will be 150,000, multiply by 1 unit, then divide by 3. So that means when you discontinue what? Producing product who? Y fly, that spare capacity can be used to produce 50,000 units of who? No fly. So 150,000 units of Y fly can be substituted with 50,000 units of who? No fly. Then note number 3, to increase demand for no fly, a 20% price reduction will be allowed next year after dropping what? Y fly. So let's get our total units of who? No fly. Will be the current sales demand of 60,000 and your new production as a result of discontinuing who? Y fly. So your new production of no fly will be 110,000 units. Let's determine our new selling price of no fly. They're saying that as a result of increasing demand, they expect that a price deduction of what percent? Of 10% of no fly will be implemented. The current selling price of no fly is 30 shillings. So your new selling price will be 90% of who? 30. Because remember, the selling price is doing what? Reducing. So this will give you how much? 27. Then your contribution margin, you're now going to take your current selling price or your new selling price of 27. You subtract your variable cost. And your variable cost was how much? 12 shillings. Your variable cost was 12 shillings. So the contribution margin of no fly after discontinuing who? Y fly is 15. So here your total contribution will be 15. You multiply by your new increased production of 110,000. So that this will give you your total contribution. This will give you your total who? Contribution. This is 800,000. That's the contribution for who? Zero fly. 15 by 110,000 is 1650. So your total contribution is 2450,000. But remember, we want to determine our who? Profits. We want to determine our profits. Remember, our profits when you continue producing the 3 products is for 90. So let's determine after dropping fixed, we are saying fixed costs. The fixed cost given by note number 4 is how much? 6.5 per unit. So you're going to take 6.5 per unit. You multiply here by your production of X, Y, and Z of zero fly, Y fly, and no fly, which is 50,000. The units of zero fly. Y fly is how much? 150,000. And no fly will be 60,000. Remember, a fixed cost remains constant. Therefore, it does not change as a result of the decision made unless it is incremental or what? Specific. Unless it is incremental or specific. So when we discontinue production of Y-fly, the fixed cost of Y-fly will still continue to be done what? Incurred. The only time it will not be incurred is if they tell us that that fixed cost is specifically incurred by product who? Y-fly. If it is specifically incurred by product Y-fly. This is 1690. We then get our what? Profits. Let's get our profits. That is 760,000. That is 760,000. Then at the end of it all, you need to advise that management of that company whether they will produce or they should continue production of that product Y-fly or they discontinue it. The product profits when you produce your 3 products including Y-fly is 490, but after you discontinue production of Y-fly, your profit increases to what? 760. So therefore you're going to tell them discontinue production and sale of who? Production and sale of who? Of products Y-fly. Of product Y-fly. Why? There is an incremental what? Profit. There is an incremental who? Profit of what? Of the difference of 760 and 790, yeah? And 490, 760 and 490. Which is what? 270,000. 270,000. Right. That is how you analyze drop or continue decisions. That is how you analyze drop or continue decisions, which is an application of marginal what? Costing. It is an application of marginal costing. Right. Now, the next application of marginal costing or non-routine decision is what we refer to as special offer decisions. As special offer decisions. As special offer decisions. So the next application, so far we've talked about limiting factor, we've talked about throughput, we've talked about drop or discontinue decisions. Then the next application is what I am referring to or is referred to as special offer decision. A special offer decision that we're going to cover in the next lesson.